forexbrokers.net, and this is the final video dedicated to how to trade with oscillators. Throughout this trading academy, you will see that some topics have an extended video coverage, some others have no video coverage, and even some technical concepts will have only a limited video coverage. The idea is to cover both simple and complex terms, simple and complex examples in order for a better understanding of what technical analysis is. We will have videos also on fundamentals and on market psychologies, especially using examples, but mostly technical analysis is going to be covered here. This is the DeMarker oscillator. It's an oscillator similar with the RSI in the sense that this one here, in the sense that it has overbought and oversold levels. It travels only in positive territory, but unlike the RSI that goes from 0 to 100, this one goes to 0 to 1. That's it. If the RSI have the 70 and 30 as overbought and oversold, this one has 0.7, 0.3. But there is a difference between the RSI and the DeMarker. By the way, the DeMarker names comes from Tom DeMark, famous technical analyst, worldwide renowned. So the RSI and the DeMarker, there is a difference between the two, because the DeMarker reaches these levels 0.7 and 0.3 faster and quicker than the RSI reaches 70 and 30. In this regard, if you want, they act like a faster moving average when compared with the slower one. And some traders, as I also mentioned in the article that comes with this, that describes this concept in details, in some cases, some traders plot both oscillators, the RSI and the DeMarker, on the same chart in order to find out differences between the two, and always using the mark as the faster oscillator too, or as the signal line if you want. Imagine you want to sell overbought, you want to buy oversold, but because the DeMarker reaching these levels so fast, like this one here, imagine this is the overbought. The idea is not to go on the short side by the time that it reaches overbought, but when it turns from overbought back into below overbought. So in this case, it turned here. We stay on the short side all the way until it reaches oversold, and that's it. Or going on the long side, not here. We wait for the bottoming, comes back beyond or above oversold, and we go on the long side. But we see that the market here turns. Always on the entry, have the stop loss at the bottom of the candlestick if the entry is on the long side. And then if you are stopped on it, reverse the trade and recover the profits. The same can be done here. Was not an example on our on the article. Imagine you go on the short side here, on this candlestick here, but we see that the market go on the short side here, stop loss at the top, the market reversed and then continued in a divergent mode here, so there's plenty of room to recover the loss. The same here, imagine here, go on the short side, the market reversed and plenty of room to recover the loss. The next oscillator to be part of this article is the stochastic. Again, a popular oscillator with the retail trading community. It has overbought and oversold levels as well. It travels only in positive territory too. 80 level is overbought, the 20 level is oversold, and it's two lines. One is the signal line, the red dotted line, and the other one is a slower line. So the idea is to wait for both lines to reach overbought and oversold, and then to go on the short side in overbought territory by the time that the signal line crosses above the slow one. Now again, using the same principle with that we used on the DeMarker oscillator, we wait for the stochastic to get back into normal territory, not overbought anymore, before going on the short side. And that would be a nice trade. Imagine we go short here, this would be a nice trade to the downside. The same here to the upside, the same here to the upside, and so on. Why do we say ignore here? Well, try to ignore when periods of congestion, when the stochastic oscillator fails to travel in a clean line from overbought to oversold or oversold to overbought. For instance, this would be a great trade on the short side because the stochastic traveled in a without crosses from oversold to overbought. This one is a more riskier trade because there was one cross here. This is a great trade on the long side. This is a great trade on the short side because the crossing came close to the overbought level here. But this one, try to ignore as much as possible. Don't go on the long side here. Look what happened. This one, try to ignore as well. Don't go on the long side. On the long side, actually here, look what happened as well. Sometimes it is best to avoid getting caught in complicated situations by simply respecting the rules. This is called the relative vigor index, comes with the standard interpretation, and the relative vigor index is formed as well by two lines. It travels both in positive and negative territory, and the key is to trade the crossing of the zero level. It works very well also with divergences, but we will discuss this later in this trading academy. Try to go on the long side and on the short side on clean breaks, like on clean moves like this one here. Focus on the price, where the price is, how the RVI crosses the zero level here. The same here. Try to avoid and to ignore multiple crosses before the RVI comes to the zero level. Last but not least, this is the gold chart on the hourly chart, on the hourly time frame, and the oscillator here, this vertical line that you see, this is called the Williams percentage rate, percentage range, a very famous oscillator, a very popular one, but one that travels even faster from overbought to oversold. It travels this one only in negative territory when compared with the RSI or with the DeMarker. And it has minus 20 as overbought and minus 80 as oversold. The problem with it is that you cannot trade overbought and oversold, especially if you have a trend like it is this one on the daily chart, sorry, not hourly chart, on the daily chart on the gold market. Since August 2018 all the way until January 2020, the market is simply on a rising trend, forming a series of higher highs and higher lows with modest consolidations, but keeping a bullish bias. We know by now, based on what we've learned on the trending conditions, is that every time the market, or as long as the market keeps the higher highs and higher low series in place, that's a bullish trend. In other words, why not using an oscillator that reaches the fastest overbought areas in order to add to the bullish trend? So oversold area to add to the bullish trend. So if this is a bullish trend, the first thing you need to do is to realize this is a bullish trend. So a series of higher high, higher lows, higher high, higher lows, higher high, higher lows. By the time that you have this one in place, then you go on the long side. Every time this one reaches oversold, great place to go on the long side. Every time it reaches oversold, great place to go on the long side, and so on and so forth. Even here is a great place to add for the market to make another higher high. Thank you for being here. This was a series of 4 videos dedicated to oscillators, an introduction to the most important ones. We'll do the same with Bollinger Bands indicators and with moving averages, as they are important concepts, especially here on the rookie side, on the rookie part of this trading academy, but also with the Elliott waves theory and some fundamentals as well. Thank you again. Bye bye.